Hey, buddy, come in. You're such a good dog. What is Bitcoin? How does Bitcoin work? Should an investor over 35 care about it in 2026? Those are the three questions this video answers completely. Stay with me for the next 14 minutes, because what you're about to understand will permanently change the lens through which you read every financial headline for the rest of your life. On September 12, 2017, Jamie Dimon, the CEO of JP Morgan Chase, the largest bank in the United States, stood at the Delivering Alpha conference in New York and delivered what he believed was the final word on Bitcoin. He called it a fraud. He said he would fire in a second any JP Morgan trader caught buying it for being, in his exact words, stupid. He said it was worse than tulip bulbs, that it would not end well, and that someone was going to get killed. Bitcoin was trading at $5,685 that day. 7 years later, JP Morgan Chase is an authorized participant in BlackRock's spot Bitcoin ETF, the largest Bitcoin fund on earth. The same institution, whose CEO called Bitcoin a fraud, now provides the institutional plumbing that allows hundreds of billions of dollars of capital to flow into the very asset he dismissed. And Jamie Dimon has not explained publicly, at least not completely, exactly when his bank changed its mind or why. 1 month later, on October 13th, 2017, Larry Fink, the CEO of BlackRock, the firm that manages more money than any other institution in human history, spoke at the Institute of International Finance and described Bitcoin in precise terms. He said, "Bitcoin just shows you how much demand for money laundering there is in the world. That's all it is." On October 28th, 2025, Fink sat on a panel at the Future Investment Initiative in Riyadh, Saudi Arabia, and said something entirely different. He called Bitcoin digital gold. He described it as an asset of fear, something investors reach for when they believe their governments are debasing their currencies. And at the NYT Dealbook Summit the following month, he was explicit. The long-term fundamental reason you own Bitcoin is because of debasement. The man who built the world's largest asset management firm, $13 trillion under management, spent 8 years calling Bitcoin a tool for money launderers. Then he built the world's largest Bitcoin ETF and put 800,000 Bitcoin into it. Understanding why one of the most sophisticated financial minds on earth made that journey tells you more about what Bitcoin actually is than any price chart or prediction ever will. My name is John, and this is Engineered Markets. If you are watching this video, you have probably heard the word Bitcoin thousands of times. You have heard it from your children, from colleagues at work, from the television, from politicians who either love it or cannot stop warning you about it. But here is what almost nobody has actually explained. Not the price, not the speculation, not the noise, but what Bitcoin actually is, how it works, and why investors over 35 should understand it right now at a structural level. This is not a video about getting rich. This is not a trading guide or a price prediction. This is the Bitcoin explanation that Larry Fink had to seek out himself, the one that took him from calling it an index of money laundering to managing the largest Bitcoin fund on the planet, delivered clearly, honestly, and with the seriousness this subject deserves. To understand what Bitcoin is and why it exists, you have to start with the thing it was designed to replace. Not stocks, not gold, not real estate. Money itself, specifically the kind of money that governments control and central banks manufacture without limit. Most people, over 35, grew up with an intuitive understanding of money. You worked for it, you saved it, and you trusted that $1 today would be worth something close to $1 tomorrow. That assumption, which was reasonable for most of the 20th century, began breaking down in ways that never made the front page of any newspaper. On August 15, 1971, President Richard Nixon made a decision that every serious investor should understand, but that almost no mainstream financial commentary explains clearly. He ended the convertibility of the US dollar to gold, meaning the dollar was no longer backed by a physical, finite asset with independent value. From that moment forward, the dollar was backed by nothing except the promise of the United States government and the judgment of the institutions managing it. For decades, this worked reasonably well. The Federal Reserve managed the money supply with enough discipline that the system held together, but something happened in 2008 that changed the equation permanently. And then something happened in 2020 that changed it again at a scale that should concern every person who has spent decades building savings. In 2020, the United States executed the fastest single-year expansion of its money supply in American history. The Federal Reserve created approximately $3.3 trillion new dollars between February and November alone, more new money in 9 months than in any prior decade on record. The total M2 money supply went from approximately $15.4 trillion in early 2020 to over $21 trillion by early 2022. If you had $100,000 sitting in a savings account during that period earning close to 0% interest, you did not just miss returns, you experienced what economists call monetary dilution. the quiet, technically legal process by which the purchasing power of your savings was reduced without anyone taking a single dollar directly from your account. You felt it. You felt it every time you went to the grocery store and noticed the same cart of food cost 30% more. You felt it when you looked at the price of homes and realized the house you bought 20 years ago for $250,000 now sold for $600,000. Not because the house became better, but because the dollars measuring it became weaker. You felt it when your savings account paid 0.1%, while inflation was running at 8% annually. This is not a conspiracy theory. This is arithmetic. And Bitcoin was built as the architectural response to exactly this arithmetic, designed specifically for the world where governments can print money without limit, and individuals have no protection from that decision. So, what is Bitcoin? Explained as simply as possible. Bitcoin is a public ledger. That is the core of what it is, not a company, not a coin, not a technology startup. A record of who owns what, not held by a bank, not controlled by a government, not managed by a corporation, but maintained simultaneously by tens of thousands of computers around the world, each holding an identical copy, each verifying every transaction against the same mathematical rules. When you send someone Bitcoin, you are not sending a file or a message. You are broadcasting to the entire network a signed mathematical statement that says, the person who held this amount before now authorizes its transfer to this new address. Every node on the network checks that statement against the shared record, and if it passes, which it either does or does not, there's no gray area and no appeals process, the ledger updates automatically. No bank approves the transaction, no government can reverse it, no corporation can freeze it. The ledger updates because the mathematics say it should, and the mathematics answer to no one. To understand how Bitcoin works differently from what you use today, consider what happens when you wire money. You instruct your bank to reduce your balance and increase someone else's. Your bank sends a message to a clearinghouse, which coordinates with another bank, which updates their ledger. At every step, a human institution makes a judgment. Is this transaction permitted? Is this account in good standing? Does this comply with our policies? Does this comply with the government's instructions? In 2013, the U.S. government instructed financial institutions to cut off banking services to entire industries it had decided were undesirable. In 2022, the Canadian government instructed banks to freeze the accounts of individuals who had donated to a political protest it disapproved of. People who had committed no crime, whose money became inaccessible by institutional decision alone. In 2023, multiple cryptocurrency-friendly banks in the United States lost their charters or faced coordinated regulatory pressure in what analysts described as a targeted campaign. Jack Mallers, the CEO of Strike and founder of 21 Capital, publicly disclosed in November of 2025 that J.P. Morgan Chase had closed all of his personal bank accounts without explanation, citing only the Bank Secrecy Act. In each case, money that people believed was theirs became inaccessible, not because they committed a crime, but because an institution made a decision. Bitcoin does not have a compliance department. It does not have a board that receives phone calls from regulators. It does not have an off switch. Now here is the second feature that separates Bitcoin from every other financial instrument ever created, and the one that makes it a legitimate inflation hedge for investors over 35. There will only ever be 21 million Bitcoin. Not 21 million more. 21 million total. Forever. This is not a promise made by a CEO who could be replaced, or a policy that could be overruled. It is a mathematical rule written into the code itself, enforced simultaneously by every node on the network. If someone attempted to create a version of Bitcoin with more coins, the rest of the network would reject it. The change would not propagate. The attempt would fail silently. New Bitcoin enters circulation through mining. Computers running calculations that secure the network are rewarded with newly created Bitcoin. But this reward is programmed to cut in half approximately every 4 years in an event called the halving. In 2009, miners received 50 Bitcoin per block. In 2012, 25. In 2016, 12.5. In 2020, 6.25. In April of 2024, it dropped to 3.125. By approximately the year 2140, the last Bitcoin will ever be mined. The supply is not just limited. It is mathematically, permanently, irreversibly finite. In a world where every central bank is printing money at historically unprecedented rates, Bitcoin is the only monetary instrument in human history structurally incapable of being inflated by human decision. That is what Bitcoin is. That is how Bitcoin works. And that is why the question of whether Bitcoin belongs in a long-term portfolio for investors over 35 is not a question about technology. It is a question about monetary history. If you've made it this far, you're not watching this the way most people do. You're not skimming, you're not distracted. You're actually processing what's being said, And that alone already puts you in a very small group of people. So now I'm genuinely curious about you. Where are you watching this from right now? What city are you in? And what's the weather like there today? Drop it in the comments. I read more of them than you think, especially from people who reach this point in the video, because there's a pattern I've noticed over time. The ones who stay until here are usually the same ones who start seeing things earlier than everyone else. Let me know where you are. Now, let's continue. When Larry Fink called Bitcoin money laundering in 2017, he was not alone. The smartest, most credentialed financial minds on earth looked at Bitcoin and saw a speculative toy at best and a criminal instrument at worst. Understanding specifically what evidence moved them, what argument they encountered that changed their conclusion, is more important than any price chart available. The first man to move publicly and dramatically was Tudor Jones. Tudor Jones is the founder of Tudor Investment Corporation. He is best known for correctly predicting and profiting from the Black Monday stock market crash of October 19th, 1987, the single worst day in stock market history, when the Dow Jones Industrial Average fell 22% in one session. His fund returned 125.9% after fees in 1987 alone, and he reportedly made approximately $100 million that day. His flagship fund, Tudor BVI Global, claimed long-term annual returns of close to 19.5%, a track record reported by the New York Times as recently as 2014. When Tudor Jones writes a letter to his investors, serious people read every word. In May of 2020, as central banks around the world were printing money at a pace he described as leaving even a market veteran like himself speechless, Tudor Jones published a letter to his investors entitled "The Great Monetary Inflation." Central banks had just created approximately $3.9 trillion, 6.6% of global GDP, in a matter of months. He ran what he called an inflation race, comparing 8 assets on their ability to preserve purchasing power. He wrote, "The best profit-maximizing strategy is to own the fastest horse. If I am forced to forecast, my bet is it will be Bitcoin." He was not saying Bitcoin was perfect. He was saying it was the only asset with a mathematical guarantee of scarcity in a world where every other asset's supply could be expanded by human decision. By October of 2024, he was on CNBC saying plainly, "I think all roads lead to inflation. I am long gold, long Bitcoin." He added that the U.S. national debt had ballooned to nearly 100% of GDP from 40% just 25 years earlier, and that this trajectory had no resolution that did not involve significant currency debasement. The second man to move publicly was Stanley Druckenmiller. Druckenmiller managed money for George Soros from 1988 to 2000, including the 1992 trade that broke the Bank of England, one of the largest single currency trades in market history, which reportedly earned more than $1 billion in a single transaction. He then ran his own fund, Duquesne Capital, and maintained an average annual return of 30% over 30 years, with 0 losing years, not one. 30 consecutive years of positive returns, which is considered by most professionals to be the most extraordinary long-term track record in institutional investing history. Druckenmiller did not come to Bitcoin easily. In 2021, he acknowledged owning some Bitcoin, but described his gold position as many, many times larger. In 2022, when central banks began raising rates aggressively, he sold his Bitcoin entirely. Then, in October of 2023, at an investors' conference in New York alongside Tudor Jones, he said what has since become one of the most quoted lines in institutional Bitcoin discourse. "I don't own any Bitcoin, to be frank, but I should." He described Bitcoin as a brand, 17 years old compared to gold's 5,000-year history. He acknowledged that younger generations view Bitcoin as the store of value the way his generation viewed gold. And then he said the sentence that crystallized the generational argument more precisely than any analyst report: "The young people have all the money, certainly the ones on the West Coast do." By March of 2026, he told Morgan Stanley in an interview that Bitcoin has probably secured a role as a store of value and that he doubts the dollar will remain the world's reserve currency in 50 years. But the conversion that carries the most institutional weight belongs to Larry Fink, because Fink is not a trader making asymmetric bets. He is a fiduciary managing $13 trillion of other people's money. Every statement he makes is filtered through legal, reputational, and fiduciary obligations that come with that responsibility. When Fink changes his mind publicly and completely, it is not a trade. It is a policy shift affecting the largest pool of managed capital on Earth. In 2017, he called Bitcoin an index of money laundering. In 2024, sitting for a CNBC interview, he acknowledged he had been wrong and described Bitcoin as a legitimate financial instrument that allows non-correlated returns. An instrument you invest in when you believe countries are debasing their currencies by excess deficits. By August of 2025, as BlackRock's iShares Bitcoin Trust crossed 781,000 Bitcoin in holdings, he publicly called Bitcoin digital gold and said simply, "I became a believer." At the Dealbook Summit in December of 2025, he was explicit about the mechanism driving the decision. The long-term fundamental reason you own Bitcoin is because of debasement. And in Riyadh, he revealed what no financial journalist adequately covered, that sovereign wealth funds, the largest government investment pools on earth, were buying Bitcoin incrementally at $100,000, at $120,000, not speculatively, as permanent policy allocations. As of April of 2026, BlackRock's IBIT holds over 800,000 Bitcoin, making it the largest Bitcoin fund on earth by a factor of 3. Then there's Michael Saylor, the figure who took the institutional Bitcoin argument furthest, fastest, and most publicly of anyone. Saylor is the co-founder of MicroStrategy, a software company he built over 3 decades. In August of 2020, he made a decision that had no precedent in corporate finance history. He converted his company's entire cash reserve into Bitcoin, not a portion, the entire reserve. His reasoning was structural. He had watched the purchasing power of corporate cash erode in real time and concluded that holding dollars on a balance sheet was not a conservative strategy. It was a slow, guaranteed loss. He described holding cash in an era of money printing as sitting on a melting ice cube. What followed is documented in public filings available to anyone. As of April 20th, 2026, Strategy, the company formerly known as MicroStrategy, holds 815,061 Bitcoin, acquired for approximately $58 billion. That position represents approximately 3.8% of all Bitcoin that will ever exist. When asked in February of 2026 whether the company would ever sell, Saylor said without hesitation, "I expect we'll be buying Bitcoin every quarter forever." And then there is Jamie Dimon, whose story is the most instructive of all, precisely because it has not fully resolved and the contradiction at its center is itself a data point worth studying. Dimon called Bitcoin a fraud in 2017 at the Delivering Alpha conference. He repeated the fraud characterization in April of 2024, calling it a public decentralized Ponzi scheme in a Bloomberg television interview. He has maintained this rhetorical position even as JP Morgan built cryptocurrency custody services, launched JPM Coin, the bank's own blockchain-based currency, and became an authorized participant in BlackRock's Bitcoin ETF, providing the institutional infrastructure that enables hundreds of billions of dollars to flow into the very asset its CEO calls a Ponzi scheme. The gap between what Jamie Dimon says and what JP Morgan does is itself a data point. The largest bank in America, whose CEO has spent years calling Bitcoin worthless, cannot stop building infrastructure for it, not because of ideological conversion, but because its institutional clients are demanding access, and JP Morgan, as a fiduciary, is providing it regardless of its CEO's stated views. Michael Saylor did not stay alone for long. The corporate treasury movement he started in August of 2020 has spread across continents, industries, and regulatory jurisdictions in ways that would have seemed implausible 3 years ago. What began as one software company's unconventional balance sheet decision has become a global institutional architecture, and the geography of that architecture tells you something important about who is watching fiat currency debasement most closely. In Japan, a publicly traded company called Metaplanet made a decision in April of 2024 that mirrors Saylor's almost exactly. Japan has been running near zero interest rates for decades, printing money to manage a national debt that exceeds 260% of GDP, and watching the yen depreciate against virtually every hard asset on Earth. Metaplanet's CEO, Simon Garovich, identified Bitcoin not as a speculative bet, but as a structural response to yen debasement, the same argument Saylor made about the dollar, applied to a currency losing value even faster. As of March 31st, 2026, Metaplanet holds 40,177 Bitcoin, making it the third largest corporate Bitcoin treasury on Earth, and the first non-American company to break into the global top 3. Its stated target is 100,000 Bitcoin by end of 2026. The significance of a Japanese company holding 40,000 Bitcoin is not the number. It is the logic. Japan's government has been doing in slow motion for 30 years what the United States did in 9 months in 2020, printing money to manage debt that cannot be repaid in real terms. Metaplanet's Bitcoin position is a Japanese corporation saying publicly, through a filing on the Tokyo Stock Exchange, that it trusts the mathematics of a fixed supply asset more than it trusts its own central bank. In December of 2025, a new company listed on the New York Stock Exchange under the ticker GIXY1. Its name is 21 Capital. Its CEO is Jack Mallers, founder of Strike, a Bitcoin payments application used globally. His majority owner is Tether, the company that issues the world's largest stablecoin with over $185 billion in circulation. Its significant minority investor is SoftBank Group, managing $330 billion in assets. Its SPAC sponsor was Cantor Fitzgerald, led by Brandon Lutnick, the son of Howard Lutnick, the United States Secretary of Commerce. 21 Capital listed with 43,514 Bitcoin in its treasury, making it the second largest publicly traded corporate Bitcoin holder behind Strategy. Mallers described the mission at launch in a single sentence. Bitcoin is honest money. That's why people choose it, and that's why we built 21 on top of it. He has stated publicly that the company intends to buy as much Bitcoin as it possibly can, not as a treasury reserve to be liquidated, but as the foundation on which an entirely new category of Bitcoin-native financial services will be built. Then, in April of 2026, Morgan Stanley, one of the largest wealth management firms in the United States with 16,000 financial advisors and $8 trillion in client assets, launched the first spot Bitcoin ETF ever issued by a major American bank. The fund trades under the ticker MSBT. It holds physical Bitcoin directly and charges an annual management fee of 14 basis points, the lowest fee of any spot Bitcoin ETF on the market, undercutting BlackRock's IBIT by 11 basis points. Morgan Stanley did not launch this fund out of philosophical conviction. It launched it because its 16,000 wealth managers, serving some of the wealthiest individual clients in America, were being asked for Bitcoin exposure at a volume that could no longer be redirected to third-party providers. Morgan Stanley Wealth Management had already formally recommended in November of 2025 that clients consider allocating between 0 and 4% of their portfolios to Bitcoin. Phong Le, the president and CEO of Strategy, observed publicly that even a modest 2% allocation across Morgan Stanley's $8 trillion wealth platform could drive approximately $160 billion into Bitcoin, far exceeding the total current size of all spot Bitcoin ETFs combined. The fund pulled in $100 million in its first week of trading. And then there are the sovereign wealth funds, the government investment vehicles that manage the national savings of entire countries, whose movements are disclosed quarterly through mandatory SEC filings, whose decisions represent the most conservative and heavily scrutinized capital allocation decisions on Earth. Mubadala Investment Company, Abu Dhabi's sovereign wealth fund managing over $300 billion in assets, disclosed in early 2025 that it had purchased $436 million of BlackRock's Bitcoin ETF. By the end of 2025, Mubadala and its sister entity Al Warda Investments had combined Bitcoin ETF positions crossing $1 billion, and Mubadala continued adding shares through price declines, a signal of conviction rather than momentum chasing. Barclays, one of Britain's largest banks, disclosed $131 million in Bitcoin ETF holdings. Brevin Howard, one of the world's most respected macro hedge funds, disclosed $1.4 billion in Bitcoin ETF positions. These are not hedge funds making leveraged short-term bets. These are among the most conservative, most heavily regulated, most scrutinized pools of capital on Earth: government sovereign wealth funds, major banking institutions, pension-adjacent macro managers, and they are all, through different vehicles and at different paces, arriving at the same structural conclusion. Here is where this conversation becomes personal, specifically for investors over 35, thinking about long-term wealth preservation, retirement planning, and what their savings will actually be worth when they need to spend them. If you are 35 today, you have roughly 30 years of working and saving ahead of you. If you are 50, you have 15 years. If you are 60, you have 5. In every one of these scenarios, the central question is not just how much you accumulate, it is how much your accumulated savings will actually be worth when you need to spend them. The answer to that question depends entirely on what happens to the purchasing power of the dollars sitting in your accounts. And the purchasing power of those dollars depends entirely on decisions made by people you did not elect, sitting on committees you cannot audit, managing systems built on assumptions established before you were born. A dollar today buys what 3 cents and 62 cents bought in 1913. The Federal Reserve was created in 1913, specifically to stabilize the currency. What followed was a century of consistent structural decline in purchasing power. 2% inflation per year for 40 years reduces the purchasing power of your savings by more than half before you spend a single dollar in retirement. Now ask yourself, what is the plan for the next 40 years, given that the United States is carrying $36 trillion in national debt, running annual deficits of close to $2 trillion, and facing demographic pressures? An aging population, a shrinking workforce relative to retirees, that make those numbers structurally worse every year? The Congressional Budget Office projects that federal interest payments alone will exceed $1 trillion annually by 2026, more than the United States currently spends on national defense. There is no mathematical path out of this situation that does not involve spending cuts that are politically impossible, tax increases that create economic pain, or the quiet, steady dilution of the currency that makes the debt cheaper in nominal terms by making your savings worth less in real terms. Paul Tudor Jones said all roads lead to inflation. Stanley Druckenmiller said he doubts the dollar will remain the world's reserve currency in 50 years. Larry Fink said sovereign wealth funds are buying Bitcoin at $100,000 because they believe currencies will continue to be debased. These are not cryptocurrency enthusiasts. These are the people whose institutions manage tens of trillions of dollars, and they are all describing the same structural problem. And then, on March 6, 2025, the United States government said something that ended a debate that had lasted 16 years. President Trump signed an executive order establishing the Strategic Bitcoin Reserve, the first time in American history that a cryptocurrency has been formally designated as a reserve asset of the federal government, in the same category as gold, petroleum, and strategic pharmaceutical stockpiles. The order established a separate office within the U.S. Treasury to administer approximately 207,000 Bitcoin, seized through criminal and civil forfeiture proceedings, as a permanent national reserve. The White House fact sheet explicitly stated that the United States will not sell this Bitcoin and that it shall be maintained as reserve assets of the United States going forward. The White House, crypto czar David Sachs, called it a digital Fort Knox. The Federal Register entry itself cited Bitcoin's fixed supply of 21 million coins and its unbroken security record across 16 years as the rationale for its strategic designation. When the United States government designates Bitcoin as a strategic reserve asset in the Federal Register alongside gold and petroleum, the question of whether Bitcoin is a legitimate asset is settled. That debate ended on March 6, 2025. If you have stayed with this video this far, you have earned the most important section, the one that most Bitcoin content will never give you, because most Bitcoin content is created by people who want you to buy Bitcoin and who would prefer you not think carefully about the risks. Bitcoin could fail? Not probably. Not likely given the current trajectory, but it could. And any honest Bitcoin explanation has to sit with that possibility seriously. The first risk is regulatory reversal. No government in history has willingly surrendered monetary control without resistance. The current U.S. administration is explicitly pro-Bitcoin. The next administration may not be. A coordinated G7 regulatory response, while increasingly unlikely given the institutional trajectory, is not zero probability. A hostile regulatory environment could make Bitcoin functionally inaccessible for most retail investors through friction rather than outright prohibition. The second risk is technical. Bitcoin has operated without a catastrophic security failure for 16 years. Quantum computing, while nowhere near the capability required to threaten Bitcoin's cryptographic foundations today, represents a long-term technical risk that serious cryptographers take seriously. The Bitcoin development community is actively researching quantum-resistant cryptographic upgrades, but the timeline of quantum computing advancement is genuinely uncertain. The third risk is concentration. As of March of 2026, Strategy alone holds approximately 76% of all Bitcoin owned by corporate treasury companies. One company controlling that concentration of an asset, whose entire value proposition rests on decentralization, creates systemic risk that did not exist when this narrative began. Saylor has repeatedly stated he will never sell, but the gap between stated intentions and institutional realities has historically been wider than anyone expected. The fourth risk is you, specifically custody. Your private key, if lost, means your Bitcoin is gone permanently, not recoverable, not insurable by the FDIC, not retrievable by calling customer service. Approximately 3 to 4 million Bitcoin out of the 19.8 million mined to date are estimated to be permanently lost due to forgotten passwords, damaged hardware, and the deaths of holders who left no record of their credentials. Bitcoin custody requires a discipline that a savings account at your local bank does not demand. And here's a fifth risk that is often used as a bull case but deserves honest treatment: the divergence between institutional conviction and institutional behavior. The State of Wisconsin Investment Board, a public pension fund, was among the first American pension funds to disclose Bitcoin ETF holdings in 2024, allocating approximately $321 million. By the first quarter of 2025, it had exited its entire position during a price decline. Abu Dhabi's Mubadala, by contrast, added to its position during the exact same price decline. The difference between those two decisions is not intelligence, it is time horizon. A pension fund with quarterly reporting pressure behaved differently than a sovereign wealth fund with a 50-year investment mandate. For retail investors over 35 managing their own savings, the question is which time horizon you're actually operating on. But here's what none of those risks change. They do not change the arithmetic of fiat debasement. They do not change the $36 trillion national debt. They do not change that Larry Fink called Bitcoin money laundering and now manages 800,000 Bitcoin in the world's largest ETF. They do not change that Paul Tudor Jones described it as the fastest horse in the inflation race. They do not change that Morgan Stanley launched its own Bitcoin ETF and recommended 4% allocations to clients. They do not change that Mubadala was buying at $100,000 while Wisconsin was selling at the same price, and that one of those decisions was made by a pool of capital operating with a 50-year investment horizon. They do not change that the United States government holds Bitcoin as a strategic reserve asset in the Federal Register. Risk is real, but risk is not a reason to remain uninformed. The risk of understanding Bitcoin is exactly zero. Before we continue, if you have made it to this point in this video, you are in a very small percentage of people who take their financial education seriously enough to sit with complexity rather than reaching for a headline. Drop your city, the time where you are, and what the weather looks like right now. I read every single one. And if this video has given you a framework you did not have before, hit the like button. It takes 2 seconds, and it tells the algorithm that serious, unsponsored analysis deserves to reach more people. Here is what serious institutional research has consistently found when analyzing Bitcoin as an investment for long-term portfolios. A study published by Fidelity Digital Assets analyzed the effect of adding between 1% and 5% Bitcoin allocation to a traditional 60-40 portfolio across multiple time periods and risk parameters. The finding was consistent. A small Bitcoin allocation improved the portfolio's risk-adjusted returns because of Bitcoin's historically low correlation to traditional asset classes. Bitcoin does not move in lockstep with stocks. It does not move in lockstep with bonds. In periods of acute dollar stress, it has historically moved in directions disconnected from both. For investors over 35, thinking about whether Bitcoin belongs in a retirement portfolio or long-term wealth preservation strategy, this research is the right starting point. Not price predictions, not trading strategies, but the structural question. Does a fixed supply, non-sovereign, non-correlated asset improve the risk-adjusted performance of a diversified long-term portfolio? The institutional research from Fidelity, from BlackRock, from Morgan Stanley's formal recommendation says yes at small allocations. Gold has served as a monetary hedge for 5,000 years. It is scarce, durable, and not controlled by any government. These properties made it the dominant store of value in human history until 1971. Gold still serves that function today. The price of gold reached an all-time high of over $3,300 per ounce in early 2026, driven by the same institutional concerns about currency debasement driving Bitcoin adoption simultaneously. Bitcoin shares gold's scarcity and non-sovereign properties, but adds 3 features gold structurally cannot replicate. First, it is perfectly portable. 21 million Bitcoin can cross any border in the world with nothing more than a memorized password, while moving significant gold requires armored transport, insurance, and customs compliance. Second, it is perfectly divisible. 1 Bitcoin divides into 100 million units called satoshis, making any transaction size mathematically precise. Third, Bitcoin's complete supply schedule is mathematically verifiable by anyone with an internet connection right now, while gold's total above-ground supply remains an estimate with meaningful uncertainty. Gold currently represents approximately $18 trillion in total global market value. Bitcoin's total market cap sits at approximately $1.3 trillion as of early 2026. Whether Bitcoin eventually absorbs a meaningful portion of gold's monetary role, and the institutional movement from Fink, Tudor Jones, Druckenmiller, Mubadala, Morgan Stanley, and the US government suggests the question is when and how much, not whether, is a question about adoption timeline, not about the underlying properties of either asset. There are 3 ways a person over 35 can respond to everything in this video. The first is to ignore it, to decide this is too new, too complicated, too volatile, and too far outside the conventional financial advice you have been receiving for decades. This is a completely rational response. Bitcoin may underperform. The regulatory environment could shift. For an investor who has built a solid retirement foundation in index funds, bonds, and real estate, ignoring Bitcoin does not guarantee failure. Traditional diversified portfolios have built real wealth for millions of people. The second response is to speculate, to hear the institutional momentum, the government reserve, the Fink conversion, the Morgan Stanley recommendation, and decide the price is going up and you want to capture that movement. This is the most dangerous response for someone over 35, because speculation without understanding leads directly to panic selling during corrections. Bitcoin has historically corrected by 50 to 80% multiple times before reaching new all-time highs. The person who bought Bitcoin at $69,000 in November of 2021 and sold at $15,000 in November of 2022 did not lose because Bitcoin failed them. They lost because they speculated without understanding what they owned. Exactly like Wisconsin's pension fund selling in 2025 during the same decline that Mubadala used to add to its position. The third response is to understand to spend the time required to grasp what Bitcoin is, why it was built, what it does that no other asset does, and what risks it carries, and then make a calm, rational, non-emotional decision about what role, if any, it should play in your specific financial situation. This video is a beginning, not an ending. Understanding Bitcoin at the depth required to hold it through volatile periods takes weeks of serious reading. What it does not require is a financial advisor who has a structural incentive to keep your money in products that generate recurring management fees regardless of whether those products protect your purchasing power. On October 31st, 2008, while Congress was debating a $700 billion bailout for the institutions that had just destroyed millions of retirement accounts, a person or group of people using the name Satoshi Nakamoto published 9 pages describing a system where no individual, institution, or government could manufacture money without limit, freeze accounts without due process, or control the financial lives of people who had done nothing wrong. Satoshi built it not out of optimism about human nature, but out of complete clarity about what human institutions, given unchecked power over money, consistently do with that power across every culture, every century, every political system in recorded history. Larry Fink needed 8 years to arrive at the same conclusion. Tudor Jones arrived in 2020, Stanley Druckenmiller arrived gradually, sold under pressure in 2022, and admitted publicly in 2023 he should not have sold. Michael Saylor arrived in 2020 and has not moved since. Morgan Stanley arrived in April of 2026 with the lowest fee Bitcoin ETF in history. Mubadala of Abu Dhabi arrived in 2024 and kept buying during every price decline. The United States government arrived officially on March 6, 2025. Whether Bitcoin ultimately succeeds as the monetary technology Satoshi designed it to be will be determined over the next decade by regulators, by institutions, by developers, and by millions of individual investors deciding what to do with the savings they spent their working lives building. You now understand what the choice actually is. Not Bitcoin versus the stock market, not Bitcoin versus gold, not Bitcoin versus real estate, Bitcoin versus the assumption that the institutions managing your money have interests perfectly aligned with yours. That was the question Satoshi was asking in 2008. It is the same question any investor over 35 thinking about long-term wealth preservation should be asking clearly, calmly, and without noise in 2026. If this video gave you a framework you did not have before, comment, I see the game. If this is the clearest Bitcoin explanation you have ever seen, comment, I see the diamond. If you have a dog sitting next to you right now, comment, I love dogs. Hit subscribe. Because this channel exists to give you the analysis that the financial media is structurally incentivized not to provide. I am John from Engineered Markets, and the greatest investment you will ever make is not in any asset. It is in understanding the system that prices all of them.